The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody, and thanks for coming to today's webinar. We're going to talk about what's been happening in the market and how the different things that are happening currently are affecting us. But if you have any questions as we run through the presentation, it'd be great if you could just put them in the chat box and send them across, and we'll try and get to them as soon as we can. So thanks for that. In terms of where we are today, we're just going to run through the following bits on the presentation. So a bit of an agenda. We'll look at how the UK economy is being affected by coronavirus. We'll take a brief look at Brexit and how the talks are going and how that could affect and where we would like to be as an industry as we leave the European Union. We'll look at where the market is today. We'll take a look at our RV predictions and how the current market is affecting those. I'll take you through a bit of a summary and then we'll talk about next steps and hopefully have some questions from you as we move forward. So let's look at how the UK economy is doing today. So a lot of the news broadcasters are suggesting that the UK has been hardest hit. And if we look at the time period between April and June this year, in terms of GDP contraction, we certainly were hit very hard. We're minus 20.4, G7 minus 10.9, Eurozone 12.1. And I think Spain was probably the closest to the UK in terms of contraction at 18.5% down. We are officially in recession in the UK. And in terms of the OECD area, that fell by minus 9.8, it really does outstrip what was happening in the height of the GFC, the global financial crisis in 2009, in Q1 2009, where the OECD area fell by only 2.3%, which at the time felt like an awful lot. So the UK economy is currently weak overall. In terms of what that's doing to consumer confidence, the pandemic has really put a negative effect across most of these measures. The scores for, except for personal finances, remain 10 to 20% below the levels registered in 2019. And it was really during the lockdown that consumers showed record levels of concern about their health, their well-being. There's a lot of apprehension in the job market, the way that schools have been delayed in terms of reopening, and most of the children have now started to go back, or they should be going back this week. Although, again, there are some issues around some schools as the COVID takes effect and is potentially closing some schools just as they reopen, just because of transmission rates are increasing. Around personal finances, there's been an improvement. And probably due to the financial support from the government and incredibly low interest rates, and people are saving money. Certainly during lockdown, people just weren't spending as much money, and there were fewer foreign holidays. And the foreign holidays continue as the quarantine measures are put in place for a lot of the air corridors that started up. So there's still quarantine periods required, which takes away, unless you are working from home flexibly, it takes away the sort of the flexibility that most holidays add. When you can just take 1 week, it's taking more like 3 weeks to get back to work. So there are issues there. And in terms of sentiment, in terms of confidence, we are at a record low level of 88%. Now, unfortunately, these are great for the whole UK economy. What we're seeing in automotive, and probably in housing as well, I know that's not our industry, is that there's significant confidence, and this is really affecting prices we're seeing in used values and strengthening residual values, but also the demand that new car sales are going through is really quite high, and that's the same for vans. There was a bit of a dip in August, but you know, overall there's been a resurgence in demand. Now let's talk a little bit about Brexit. The quotes coming out over the weekend were that major difficulties still remain in terms of finding some way forward for the UK as we exit the European Union. The impact of no deal on the automotive industry is potentially catastrophic. Now, by that I mean, not everything's going to fall apart, but the pricing and the way things move between borders, over borders, because we have such a complex supply chain in automotive. Let's talk new to start off with. Production relies on just-in-time delivery. It requires parts and bits and pieces to come via Europe, and from UK into Europe. It's going to cause issues, and those issues are around, think about over half of the cars that are built in the UK are exported, and they're exported to the EU. And it's just important to get our heads around that. So it's not half; it's 80% of cars, and they just and 80% of cars are exported from the UK. Only 20% stay in the UK, the ones that are built in the UK, but they still need to go across the border. So a lot of those going through Europe to get beyond. So there are issues there. If we're talking about cars being imported in Europe, less than 4 out of 10 cars made in the big European countries are actually exported out of Europe, and roughly a third of those, about 12.4% of the production, actually come into the UK. So much less coming the other way around, but it's still important, because what that means is that those vehicles coming over the borders could be delayed further. Now, we'll talk about stock in detail a little bit later, but this is another issue that is going to impact sales in the UK. Remember, the UK automotive industry employs a huge amount of people, 856,000 people according to SMMT. And the sector adds £20.2 billion to the UK economy each year. So it is enormous. And any contraction of that at a time when the UK economy needs some good news could be real issues as we move into 2021. So what does the new no deal mean? We talked about this a lot last year, but it's worth reminding ourselves. If there is no agreement between the UK and the EU, on the 1st of January next year, the UK will default to WTO, World Trade Organization, terms of trade. Every WTO member has a list of tariffs and quotas applied to other countries, and the UK would apply these tariffs for goods arriving from the EU. And effectively, we become a third country. We have that applied when we export to the EU. It means we will be very hard hit. We'd be paying around 10% tariff on exports to the EU, and that's estimated at 5.7 billion euros per year. And effectively, every car that is exported to the EU, on average, would increase by about 3,000 euros. Currently, remember, trade between UK and EU is tariff-free. Now, that's just talking about new cars. When we talk about parts and the supply of those parts, the same thing would be true there. And it's the same coming from the EU into the UK as going from the UK into the EU. So in the event that there is no deal, the tariffs would be employed, but also the EU would immediately impose border checks to everything leaving the UK from the 1st of January. Even if there hasn't really been any change of rules and regulations around the products. So the government has already admitted that there will be the expectation of long border queues and persistent delays for up to 6 months after leaving the EU if there is no deal. So we'll start seeing on the matrix signs on the motorway to reminders for drivers, both for holidays and for deliveries, that we need to make sure that they are carrying the correct paperwork as they head into Europe out of the UK for the first time. So leaving Brexit, leaving Europe will be a big deal. It can't be sort of underestimated that this is going to affect UK car sales, particularly new cars. What it will do for used, we'll come on to later, but new cars is going to be an issue because they're going to be more expensive in the UK when we start buying them. What the SMMT have said is that they would like, they've set out a number of requirements, but the main ones are that they would like an agreement to be put in place that would deliver zero tariffs from day one. At the moment, this seems unlikely. we're in a risky period. Brexit is coming, and it's pretty unlikely at the moment that there will be a deal. We'll see. There's a lot of new negotiators working on this, including the ex-Australian Prime Minister. So who knows what he will, Mr. Abbott, what Mr. Abbott will bring to the table, but certainly from an S20 request or requirement perspective, they've asked for zero tariffs. They'd like a new framework on cooperation on regulations and dialogue put in place. But most of all, I think, it's the minimisation of frictional borders, which would be key not just for automotive, but across the rest of all industries, including import and export from the UK. Because without that, we will return to times before the EU and possibly before even the common market, where friction at borders was great and delays at borders were many. So let's hope that at least some kind of deal can be put in place sooner rather than later. Let's move on to the market. The market was paused through the lockdown, and things have really happened very quickly in automotive since the dealerships started to reopen in June. And this is the case for both car and LCV dealers. We've seen a real unfolding of demand over the last few months, for both new and used. But let's look at new to start off with, and we'd look at the car market realities first. In April, the market in terms of registrations was over 97% lower than the previous year at just 4,321 units. But as things started to sort of change and things started to move a little bit, online sales become a little bit more prevalent for new cars, 89% lower in May, and then June 34.9% lower. So really things started to really improve. And by July, there was a real buzz in the market. Some pent-up demand came out, and it really kind of overtook where we were in July 2019. August has slipped back, but August has been traditionally low before the big month in September. So the hope is now that September is a very strong month. The problem is going to be stock and the availability of that stock and getting that stock to the right customers. Whether you're a leasing or a finance customers or direct with a dealership, it's getting that vehicle to the right place so that it can be PDI'd through September and registered to make sure that September sales are high. A number of franchise dealers have spoken to us and suggested that September could have been their biggest ever month. Not just this year, but ever. The problem is stock, and getting that stock to them, and enough stock, is going to be an issue through this year, and with Brexit, potentially a big issue as we move out of this year too. Now, just looking at the year-to-date registrations, August, by the time we finished off August, we were nearly 40% lower than this time last year. Now, to claw back any of that loss will be a big ask, because we need to do it mostly in September. Now, without a big September, I think we're going to be a long, long way. Initially, we were looking around 33% lower than last year. Without a large September, this could grow and could be more closer to the 40% we're looking at there. And just as a highlight, in H1, there were 653,000 units registered, so a long way down on what we're used to through a normal year. In the LCV market, we're looking at pretty much the same kind of situation. So July was higher, 7.1% higher than 2019, 27,700 units. But August fell back quite a lot, and I think it's the same story really. People are waiting, or customers and fleet buyers are waiting for September to renew their fleets, just so that they can have the new registration plate. Year-to-date registrations aren't quite as bad in LCV. They're only 36.2% lower than 2019, with some positivity come through the first bit of September that we've seen so far. So hopefully those can continue. But again, we'll highlight the stock. Stock is still an issue for new car and new LCV sales. Just for new car market, in terms of the fuel type split, petrol share is actually beginning to erode a little bit, and we can see BEV and the PHEV/HEV, the hybrids coming on tap, and quite a lot of those being sold so far this year. Diesel market share continues to decline much more quickly than petrol, and in this this particular graph, I've included the mild hybrids in with diesel and the petrol mild hybrids in with petrol, just to get a real indication of what's happening. So yeah, petrol and diesel are starting to decline, but diesel continues to decline pretty quickly, which is interesting as we move into the used car market, because there's still demand for diesel, particularly in the used car market, because of the advantages it has over hybrids, particularly plug-in hybrids, because there's none of the company car incentives that plug-in hybrids currently have around CO2. So in the used car market, diesel is still an interesting prospect and will be for the foreseeable future, because of the lack of incentives in the used car market certainly based on CO2. So let's look more closely at the used car market for both cars and vans. We started to look at the market in a slightly different way, and we continue to develop this new metric that we have. We call it market health, and it's a look at what demand versus supply is in the retail market, and it breaks the market down by region, manufacturer, and range, and it looks at that in quite a lot of detail. Today, I'll just look at what we've got here. So this is the same slide. We'll just increase the size of the chart a little bit for you. So if we look at the top left of this, we've got this time last year, and these numbers are kind of just a smattering, a stroke at a particular point. That there are 124,426 vehicles on sale on the portals that we've looked at for this particular metric. Currently, there are, and that's the demand, so 124,000 demand, so sales going on at any particular time. Currently, there are 136, and the way I've done this is to increase the current demand. So we know that 124,000 were sold last year. We've increased the current demand to be 10% over last year's demand to 136,000, because we can see that there's still pent-up demand through September. In reality, it's probably a little bit higher than that. What we know last year was that there were 242,713 vehicles for sale. So the supply was there. This year, there's only 191,000 vehicles for sale. So there is a supply issue. It's this stock that we're talking about in the new car market. It is even more prevalent in the used car market. So last year, stock or supply versus demand was about 2 to 1 in terms of more supply, allowing the customers to actually buy what they wanted. There's a lot of supply there, so the customers could look at what they could buy, and they could take a little bit of time to buy the vehicle they wanted. Today, there is not enough stock in the marketplace, and the maps really illustrate the main pinch points that we have in the UK at the moment. Ireland, northeast of England, and Lincolnshire and Yorkshire, up the east coast, are having issues around stock. East Anglia, London, and the southeast. The other parts of the UK, perhaps not so much, where supply has really changed. And certainly East Anglia and northern home counties, there's not a huge, there's still supply change and supply is down, but the same is true about demand. So again, the demand in different parts of the UK is increasing. So there's going to be some real pinch points in these particular parts of the market. And the way we can look at that is we can actually look down to a manufacturer and even down to a model level to see what is really affecting the market at the moment. We are going to start to use this to help us form our opinions around the used market and where the used market is likely to go to. So at the moment, the used market continues to be on fire in terms of wholesale, and the values continue to go up. So let's look at what's happening to retail prices. So we're saying values are going up in the used market, but it's the same is true on the used retail market as well. So back here at the start of the graph, at the beginning of February, we're taking this as the start of the index. We fell significantly through lockdown. But it's come back very strongly, much more strongly than perhaps even we thought, particularly for those older vehicles that are offering real value for money. That's the darker green line and the sort of khaki coloured line. So the old vehicles that really start to be sought after in this place. And we're seeing those that we really think that people want to get that value for money as they move forward, mainly because perhaps they're coming into public transport and they want to get a car, or they're moving forward and they need a station car because they still want to get to the station, those kinds of things. In terms of retail stock, and I've looked at the left-hand graph is for car and the right-hand graph is for LCV. These are days in stock, and we take this from our retail tracking. We can see that right the way through COVID, real issues around getting stock and getting customers to look at stock. But both car and van have really improved very quickly, perhaps more rapidly than some people were looking at. We're almost back to normal with car. And in terms of LCV on the right-hand side, it's actually better than we were through where we had in March. So real sort of turnaround for these vehicles. Again, it's looking for that ready-to-retail stock. So when we come to wholesale, customers are looking to turn that stock as quickly as possible. So the retail customer will come along, they will buy that vehicle really rapidly today. We can see that through our analysis of the fastest selling cars in August. Now we look on a regular basis, on a monthly basis, to see what's selling quickest, and we take a minimum of 50 observations. It's not just that one mini roadster sold, for instance, and we'd look for a minimum of 50 observations to give a real indication of what's really selling. And weirdly, for this month, it's a mini roadster and not actually that old. So yes. Yeah, down the other end of the top 5 was our Ford Focus C-Max at 173 months, so taking on average 24 days to sell. But the weirdest one was the Mini Roadster, mainly because there's not a huge amount on the UK roads, but actually it doesn't offer that great value for money. But I suppose for this age, the prices are pretty good at the moment. And we're looking at a relatively low reduction in price when we look at their transacted prices. So some real positivities. And actually, our usual average day to sell is usually around 40 days. 45 days is on the top 5. To come down to 20 days on average is really rapid, and that's where the market is at the moment. Customers are buying things quickly as they come into stock. So it's great news for dealers. It's great news if you're starting to look at remarketing. But remember, the dealers are looking to turn over stock quickly. They're looking at a minimum of repair. And so, maybe 2 to 3 days of repair, not 3 weeks worth of repair. So ready to retail condition is key at the moment if you're sending cars for remarketing. So in terms of volume that's going through auction at the moment, most of the auctions are 100% online. There's a few that are inviting some customers to go along, some buyers to go along to the auction. But cars on the left-hand side, LCV on the right-hand side again, it's the purple line for 2020. Cars are significantly behind the green line of 2019. So there's a deficit here. Yes, there wasn't the demand early in sort of March and April, but the demand is returning right now. And we're not seeing enough cars coming into the wholesale marketplace to make that leap to supply the demand that is there. So we're currently seeing prices and our values going up rather than necessarily staying still, and possibly even coming down at this time of year. September will be key. We may see a huge lot of new car registrations driving part exchanges. But what we can see at the moment is that franchise dealers are tending to keep hold of as many of the part exchanges as they possibly can and selling those themselves. This again is driving further deficits in volume in the wholesale marketplace, because there just isn't the sort of the usual trade-ins that are coming towards them. So the franchise dealers would normally keep hold of maybe 2-year-old cars, maybe 3-year-old. They're now looking to 4 or 5-year-old cars where they know they can retail those very quickly indeed. The same is true, perhaps a little bit less so for LCV, but their volumes have recovered to be beyond where we were certainly in 2016, and they're not far away at all from the lighter green line for 2019. So perhaps a little bit less of a gap in the cumulative sales that we've had so far this year, the year to date. But yeah, we'll see where we go to with LCV. Obviously, September should drive some renewals of leased vehicles, so we should see more wholesale volume become available, hopefully, which will certainly go to some way to perhaps slowing down some of the increases in values that have been seen recently in the wholesale LCV market. But what about prices? The top chart is for cars and the bottom chart is for LCV. All the way through this year for cars, there have been increases versus 2019 in terms of percentage of price differences. So price difference in January, positive 4.9, and in August, 24% higher. So there's some real significant increases in the used car wholesale market price performance. And the same is true for LCVs. The LCV prices took a tumble early in lockdown, but have since recovered significantly against last year. So real positivity going into the September market. Prices are very, very high at the moment. In terms of conversion rates, we're seeing the same is true, especially as there's less volume. The conversion rates remain very high, and for August for LCV, well, August and July really for LCV, 91.1% for July, and August at 88% first time conversion, and still over 80% conversion in July and August for cars. There's some really significant sort of demand there for used cars, perhaps for the perhaps because there's less volume available, but also because there's so much demand in the used car market. We're just seeing that if the cars and the LCVs are straight, they are in good condition, they will sell immediately for incredible money, as we saw in the previous slide. So what about residual values? Now, it's been a lot of talk, and a lot of manufacturers have suggested some pretty horrifying stories going on this year. Now, we are still holding to our previous forecast here. Now, I'll give you some reasons why. We didn't see for RVs a big drop in 2020. We looked very closely at what had happened through the global financial crisis, and we took a lot of input from how the market was reacting to what COVID was doing. What we do see coming is Brexit. Now, Brexit is in some ways a positive for certainly for the used car market, not necessarily for the new car market, as I illustrated earlier. But we've got to be careful of how we move this forward. And at the moment, we're holding steady. So I'll take you through what we've got. And we need to do a little bit more work, certainly on where we see petrol and diesel currently, and where hybrid currently sits. But for the moment, we're seeing 2020 as just a small decrease. And the decrease will be driven mostly by the end of the job retention scheme in October, when we get some better idea of where we will be in terms of the job market and how redundancies are affecting the UK market. For 2021, the 12 months and 36 months out, -3% and -2.8%. That's really driven by a mixture of things that, well, in some ways we could say the market could drop significantly, but I think Brexit will drive some improvement. It really is that there's going to be a lack of supply of new cars coming to us in 2021. Certainly not as much as we would normally require, which will increase demand through the age ranges for new used cars. So there's going to be some support. Yes, there'll be fewer people, so well, unemployment will rise, let's put it that way. So fewer people will be looking for new cars anyway. So there'll be some demand for used cars, maybe people that come out of company cars, but also because there's the lack of supply of new will keep us certainly on the straight and narrow in terms of residual value. So our forecast here are actually quite positive. In 2022, there'll be some recovery. We don't know completely how much is yet, but it would suggest there'll be some rise away from the depths of the recession in 2021. As we get used to Brexit and used to what the trade rules mean, and hopefully at some point we can look at how supply and certainly reducing the friction at borders. But yeah, it's going to be an interesting 36 months as we head out into the new world of the UK without being in the EU, but also looking at how we can recover from the coronavirus and how the pandemic really sort of shifts over the next few months. Certainly we're in a risky period right now with COVID cases increasing. So we've just got to keep an eye on the market as things change. But as I said, to get the most out of any vehicles that you may be remarketing right now, they need to be in retail ready condition. So taking that step to refurb where possible, and obviously where economically viable, is the best step to make sure your vehicles sell as fast as possible. The same is true on a retail perspective. If you can have the right stock in the right place, and looking at our sort of market health demand chart gives you a really good indication of where this will be, and we're hoping to get this onto the website quite soon, working with marketing now to look at how we can sort of get more information to you, so you can use that moving forward. So let's just summarize. I've taken sort of half an hour of your time now. So there are destabilizers in the market. There's the ending of the job retention scheme. Brexit is coming along, and also stock availability, both in the new and used market, will affect how the remarketing and particularly wholesale reacts over the coming months. So when you're remarketing, make sure that your stock is in the best possible condition to set the highest possible demand, so you can look at the best return on your investments. Now, at the moment, RVs are currently stable. So in 2020, they're currently stable. So 2021, there'll be some decrease. We will tweak that. We will communicate that to you as we move forward. But yes, there'll be some reduction as we move forward. Just in terms of next steps and what you can do in terms of getting in touch with us, both Tim Budgeon and Paul Markey are available today to take your calls if you're interested in taking a free demo of our RVI, which covers all the main European markets and splits the market by car and van. There's also, when we put this online, you'll be able to sort of download our latest white paper that looks at the impact of COVID-19 across Europe, including the UK, and it includes those forecast numbers that I've just taken you through. And it gives a real indication of what's happening, what a lot of the manufacturers are trying to do, what's happening in the EV world, because don't forget that is also going on at the same time with the launches of a number of new EVs, including this one, which is my particular favourite at the moment, the Skoda Enyaq IV, which will be available, I think, next year at a very reasonable retail price. Of course, as we all know, retail price is not the be-all and end-all, and it's more your monthly figures that's going to be important, which, of course, RVs will drive. So thank you very much for your time. I'll just go take a look at some of your questions, but if you've got any other questions, please do try to just send me a few messages. So got a few today. So the first one is looking at the benefit in kind skew for new car sales. Certainly that is making skew at the moment, and this skew is towards FEV and it's towards EV, so the full BEVs. We're taking that into account as we're looking at our forecasts. The RVs of those are very strong at the moment, but we've got to be mindful that mileage of these vehicles is increasing significantly. We're seeing that through Tesla, as their vehicles are becoming used as, should we say, a normal car, just like an ICE car, an internal combustion engine car. So mileages are increasing, and we're looking at our mileage adjustments currently to make sure we are as accurate as possible. The volumes are increasing as more manufacturers launch these cars into the marketplace, albeit at relatively limited volumes. So the FEVs are pretty unlimited at the moment, and of course they're going into benefit in kind because they are so beneficial. At the moment, there's not a huge benefit to most used customers taking a FEV taking a FEV on as a used vehicle. So we are very mindful of what's happening in the market there. And if the volumes of those increase beyond where the demand really lies, there will be issues. In terms of a demand for the mild hybrids and for both petrol and diesel, they are relatively normal, because the mild hybrids are pretty much the new car and the new engine, and it will become standard in most standard ICE engines, and moving forward to have some kind of mild hybrid system helping the vehicle out a little bit. So that's the RVs and the impact of its benefit in kind on those. Another question has just come in. What supply impacts are expected from 2021 CO2 regulation, likely UK standalone? Yeah, in terms of regulations moving forward, at the moment we can see the UK will fall in line with what Europe is doing. Although, you know, your guess is as good as mine in terms of where the negotiations take us in terms of regulations. So we will be driven by CO2 in the same way Europe is driven by CO2. Company car tax may be different, but at the moment, the BEV incentive to take on a BEV as a company car is in place, with its declining benefit as we move into the next few years. FEV is still on CO2, so there is a benefit there for benefit in kind taxpayers. Whether that changes over the next few years will be interesting. Is there a consequence at the moment for RVs? Not really for FEVs, because they're not seeing that the demand for those is relatively low in the used market. So there are issues around FEVs, and perhaps the RV of those will fall more significantly as we move forward. Certainly for BEV at the moment, because of limited supply, certainly on the phase 2 BEVs, the older BEVs like Leaf and the early Zoes, and perhaps possibly the early Ioniq, there may be issues with those moving forward because of their limited ranges. But they've still got reasonably usable range. Anything above 100 miles is okay, but we'll see as sort of ENIAC proves that the value for money plus delivering 200 to 300 mile range is the way forward. So we'll see perhaps the early BEVs getting perhaps harder hit as these new BEVs come on stream. And I think I have one more question, no, a couple more questions. Do you think the demand for new diesel has shifted to the used, nearly new market? Therefore, demand for diesel is still strong. There is some indication of that, actually. The used market is still very strong for diesel, because CO2, you're not taxed on CO2 in quite the same way. And actually there's some benefit in a low CO2 diesel because VED is relatively low. In the used market with RDE2, that, you know, it's a very clean diesel. There's still issues around them because they're not obviously not zero emission, but the CO2 is so low compared to a petrol, and even some petrol hybrids. So there are pros and cons around diesel, and at the moment there's still demand because people still need a vehicle to travel significant distances. Some of the distances that perhaps an EV can't manage today, a lot of company car drivers will travel beyond an EV range in a single stint. So yeah, still great demand for diesel. I think around the new car sales, we still have the issue around diesel, and perhaps we'll see that come back. But at the moment, we don't think so. But yeah, the demand in the used market is interesting, and certainly will be as we move forward. And one last question to clarify: do your core RV forecasts assume a no-deal Brexit with tariffs on new car? At the moment, they do. Yes, we knew Brexit was coming along, so we've put in place that the likelihood now is no deal. We will refine that moving forward, but we will continue to communicate with you using these webinars on a regular basis, so that we can make sure that we are as accurate as possible for our forecasts. Okay. Thanks very much for your time. We'll be doing another one of these, and we'll get an invite out shortly in October. I hope you found it interesting. If you would like to comment on LinkedIn, if you want to know any further information, or if you want us to tweak the webinar at all as we move forward, please let us know. Just send us a message via LinkedIn or via our contact details. We're very welcome. But again, if you would like a simple sort of look at what is happening with residual values moving forward, please contact Tim or Paul, and they'll be happy to talk to you in more detail about residual value intelligence, which gives an overview of what's happening in the market. But for now, thank you very much and farewell. Thanks a lot. Bye-bye.